Mortgages for the self-employed. How can I get one?
So effectively there are three types of self-employment. Three types of self-employment.
Okay, go on.
You've had the sole traders.
Right.
Individuals, not limited. You have partnerships, obviously two people perhaps, running a partnership, but running a business together.
Husband and wife, or
could be husband and
business
wife.
Partner and yourself, yeah.
And then you have limited companies.
Okay.
So where they've incorporated.
Okay.
Then you've got directors of those limited companies. You might have one, you might have multiple directors, and it's how we treat those incomes for those different people.
Wow. Okay. So limited company directors and getting a mortgage.
Really straightforward and simple from our point of view.
Okay.
So if they're a majority shareholder, more than 50%,
okay,
or it could be a husband and wife situation, Paul.
50-50.
50-50, therefore they've got the whole amount. We will always look at their salary and then their share of net profit.
Okay.
Rather than their dividend income. So we're looking at what profit the business is making. They might not be drawing it all out.
So retained profit.
There's retained profit as well, but the profit that's there. So let's say the business has made £100,000 net profit in the year, and it's a husband and wife running the business, therefore 100%. We can potentially use all of that 100,000 plus their salaries, but they might have only taken 50,000 as a dividend.
Okay, so 100,000 is then an income that is a net profit that I've not drawn all of it or some of it, and in addition I have a salary. Let's say the salary is 25 for me, 25 for my wife, so our total income in that year is 150,000.
Correct.
Even though we've only drawn a salary of 25k.
And possibly only a small dividend.
Yeah.
Effectively what you're doing is they're effectively leaving the money in the business. You might have significant retained profits. As a lender, we can look at those retained profits and consider, would we also lend against those?
And how do you assess that in terms of how many years? Do we need to have been trading for a full year, submitted accounts with projections for a second? What do you need to see to be happy to lend?
As a general rule of thumb, we like to see 2 years accounts.
So 2 years, traded, submitted at company's house and evaluated.
Yep, absolutely.
Yeah.
We will consider shorter. You might have somebody who has gone from being sole trader to limited company. So you might only have 1 year's limited company accounts in that example. But if it's effectively the same entity, so it was a sole trader and it's now just a sole director, we're a lot more comfortable in using a shorter length of time. You might have blip years. What do I mean by a blip year? You might have a year where you've spent an extra amount on repairs, renewals, plant or machinery, and therefore your profits dropped. We then look at what's the 3-year picture look like, and can we ignore that middle year where there's been a bit of a blip? Or the most recent year, might have been a bit of a blip. How far are we into the next year? Can the accountant give us some comfort that those profits are going back to normal? And if they are, because we look holistically at cases, as I've said before to you, Paul, we can then potentially lend based on what we can see from the accountant and the accounts.
So limited company directors, effectively, it's enabling you to keep more of your profits in the business and still go out and live a normal life and get a mortgage.
Absolutely, because we're not just relying on that dividend and salary, we're looking at the actual profit that business has made.
Because everything that I've known about business is you try and do as well as you possibly can, but try and limit the amount of tax you have to pay. Yeah. And sometimes their effective tax planning hinders your ability to get a mortgage.
And if you hinder yourself, then that can cause you an issue. But if it's just purely and simply, you've just drawn a dividend out and you only need to take the 50% of the profit out as a dividend, as a lender, we're not stopping you utilising the actual profit that you've made to obtain a mortgage.
Wow. So self-employed mortgages as a sort of generic term, so the 3 types, you've got the sole trader we spoke about.
Yep.
And that's relatively straightforward. The same philosophies applies where it's you look at the trading accounts.
Often with the self-employed, we'll purely and simply look at their tax return, the SA 302 and the SA 100.
So self-employed is tax returns.
Yes.
Not so much accounts.
Not so much accounts. Yeah.
And then the second part was partnerships.
Partnerships.
Yeah.
Generally speaking, again, we'd be looking at the SA 302s or the SA 100s.
Yeah.
But you do have larger partnerships, things like solicitor practices, where we quite often will write to the company accountant in that example, write to the senior partner to obtain the income reference in that situation.
And limited company directors is different again because you've got share of profit. What happens if there's 5 limited company directors in that business? How do you assess that for income?
So if there were 5 and they were a minority director, effectively, let's say they only had 10% as their thing, that's where we would be looking at the salary and the dividend income that they're drawing from that business, rather than the share of profits.
Would you count any of the share of profits or not?
Depends on the case. I'll use a live example of one that we're looking at this moment in time. It's a family business. There's 4 directors. They've each got 25%, but they're all different. So it's mum, dad, son, daughter.
Yeah.
In that example, as long as the other family members confirm, one of the parties can draw their full 25% out at any point in time. We'd take a view on that and potentially use 25% of the profit plus the salary.
And your general underwriting would apply in terms of 4.5 times your income, it's stress tested, and loan to value is up to 70, or?
We'll go up to 80% for the self-employed. Without
80% self-employed?
80% loan to value for self-employed. We'll do interest only, or we'll do capital and interest, or we'll do a mix.
And is that so self-employed, is that same for limited company directors, partnerships and self-employed? All of those three categories of self-employed, up to 80% loan to value?
Up to 80%.
And it can be either repayment or interest only? Okay.
Absolutely.
Yeah, interesting. So are there any age limitations or challenges with self-employed mortgages?
Generally speaking, we'll take their income, Paul, right the way up to 75 from a self-employment point of view. But there can be exceptions made for limited company directors, especially where, for example, it's a family business and that the main directors are taking a back seat in that business. As long as the accountant confirms to us that they'll continue to get their income without the need to effectively work for it, they might go in for a board meeting once a month, etc. We'll use that income for potentially for the rest of their life. And as we've talked about before, our last time of applying with us is 89 years of age. So potentially we can use that income right the way through to 89.
So limited company directors have a lot of options with your building society in terms of lending and assessment of mortgage applications. And it's kind of interesting that you would write to their accountant to confirm that, yes, I might be, 80 and I go to a board meeting a month, but I'm entitled to my 25%. You still have that as an option and available to kind of assess for mortgage purposes.
Absolutely. If they're still getting that income, we can potentially use it. And again, it comes back down to this holistic approach, Paul. Looking at cases on individual merit, looking at circumstances, individual circumstances, to try and apply a common sense approach to lending.
And minimum mortgage size, maximum mortgage size?
As a lender, our minimum mortgage size is generally speaking 45,000. In terms of maximum size, 20 million.
Yeah.
But generally speaking, we see loans between 45 and £2.5 million.
Paul, thank you so much again as always. And it's so good to know that there are so many options available to you when you're a self-employed individual when looking for a mortgage. Whether you're a limited company director, a sole trader or in a partnership, speak to your financial advisor, get expert advice. And always, thank you for watching. And please remember to like and subscribe.